ACT's Rural Community spokesperson, Mark Cameron. He wants the Reserve Bank to scrap its restrictive banking capital requirements after banking bosses admitted that these rules have added billions in extra cost to borrowers, hitting farmers the hardest. During a parliamentary inquiry, BNZ revealed that these regulations have driven up interest rates for farmers by 1%, meaning a 6.5% loan costs them 7.5%. You're thinking, oh, that's not a lot. It adds tens of thousands a year in extra costs for the average farmer. In fact, the situation escalated when BNZ CEO Dan Huggins miscalculated the total financial impact, initially saying that the cost was around $200 million. However, on closer examination of the numbers, revealed that the real figure was approximately $1.8 billion. Quite a difference, isn't it? That's Leah's calculations. That's how I work things out. $600 million of which directly impacts rural borrowers. Mark Cameron says that extra cost on farmers has been eaten up by regulatory overreach. And he joins me now. Mark, good afternoon to you.
Leah, how are we?
We are good, my friend. You have called on the Reserve Bank to scrap its capital requirements. You say 1% increase in loan interest might not sound like much to some, but can you explain what that actually looks like for the average farmer?
Oh, look, in real terms, it's a lot of money. I think that, clearly 1% translates into several thousand, if not tens of thousands of dollars to the average mum and dad in rural New Zealand. Now, I just want to go back a step, Leah. I mean, it was clearly evident in conversations with the Select Committee that the capital requirements on the banks had changed in 2019. Suffice it to say, since then, the amount of capital that the 4 or 5 major lenders have to hold based on those Reserve Bank settings, it put a lot of extra onus on banks, and by virtue they just hand it on to their customers at the capital that is required and the interest by virtue that they pay. So I've just merely pointed out, well, how much extra money would circulate in the economy around New Zealand if we went back to those 1 in 100-year shock event settings rather than the 1 in 200-year shock event settings we've got now. Now, incidentally, people get their numbers wrong, and Mr. Huggins, he tried his best, and on the hop he got them wrong.
Yes.
But the wider point is, if we did go back to those 2019 settings, we're looking at about all the banking portfolio, which is billions and billions of dollars, freeing up about $2 billion. Now, that's across all sectors. And then you hone in on farming, well, that releases about $600 million, or the equivalent about 1% of interest that we currently have to pay. So I just make the point, if the government is hell-bent on sort of doubling revenue export earnings between now and the next 10 years, this is a great opportunity to do so.
Mark, because you see, you're right, ACT warned about these rules back in 2019. Why do you think these warnings were ignored? I mean, is it, okay, if we go back then, is this an Adrian Orr issue? Was it a then Labor government prompt?
If I may, I'm not going to overplay my hand and blame any one thing. I think it was a culmination of things. Arguably, you brought in Adrian Orr. I think he was naturally quite a conservative person, and there were changes under, some guidance from obviously the Crown at the time. Now, in terms of fiscal and monetary policy, we've always advocated for a very clear demarcation between what the Reserve Bank does and how governments set standards. I mean, we don't want to be parroting and interfering with what the Reserve Bank does once those settings are clearly defined. That all said, for reasons of conservatism, I think that were overreached by Adrian Orr and some of the Reserve Bank board, we've seen the implementation in 2018, 2019 of this change of capital requirements of all the major banks, which basically said they had to double the capital that they hold for lending. Now, invariably, I'm not the most clever mathematician, as are many, but it was quite apparent that that was just going to lean on, the consumer of the product, which is the borrower. And Leah, it's hurt people, right? I mean, the average, 30 basis points equals about 1% on an interest bill. Well, for a lot of guys, a lot of people, that's a lot of money.
It is.
So,
Mark, though, wouldn't
that,
you, and that, and just sorry to interrupt, but some would argue, though, that the capital requirements are there to protect financial stability. So, I mean, how would you respond to that?
I would agree. I would agree, and it's finding the right balance.
Right.
This is not an abandonment of banking criteria and constraint. That I say that when we are looking across the board at the banking industry as a whole, the overall nexus and the overall problem of all of this, it all seems to come back to the banks themselves are heavily regulated. So there's limited competition in the banking industry. We've got problems with fintechs and financial institutions entering into New Zealand to invest in banking. And again, of course, you've got all the capital requirements. The net result of all of that is we have a very truncated group of bankers trying to do their best. They're over-regulated, and by virtue, the consumers are saying some of the products are limited on offer, and certainly the interest rates that they pay, beg your pardon, based on those capital requirements are onerous. So I think there needs to be a rejigging, and certainly the commentary that I've heard from those in the banking when they take their hat off for the moment as bankers and say, yep, what it would look like in the eyes of consumer, they agree.
Yeah.
They're too constrained, and they know that basically constrains their consumer at the other end.
Mark, I saw a survey that was released not long ago, end of December, so you know what, 2 and a bit months ago, by Federated Farmers who surveyed some 600 farmers, and 52% of them said that they didn't. They were concerned about their bank and what was put on them. Which, I mean, you'd say 52%, all right, well, that's half. But in 2018, I think it was 83% that said that they, so 83% had said that they were happy. So there's been a real, since then, and you mentioned 2019, but there's been a real degrade in what farmers feel that they're getting supported by their banks. Or that, I mean, I think 11% reported being asked to use overdrafts for capital projects. So, they're not satisfied with their banking relationship. It's continuing, and it's been like that for some time, Mark.
Yeah, look, Leo, I totally agree. I always used to say that the mark of a genuine bank manager in rural New Zealand, you open the boot and they've got gumboots in the back. They've gone around the farm. They've seen how the cow-cockers, the wool growers actually do it. There's the mark of a real bank manager. Not to say that if they don't, they aren't. I just think that engagement is key. The wider point, some farmers have said to me, and it came up all through the hearings of evidence thus far, that they, in some instances, felt that banks, for various reasons, were being unnecessarily prescriptive. And what I mean by that, and you touched on it before, when farmers were making capital investments, on farm, they were arguably being offered to operate that reality through their overdraft facility versus a term loan facility, i.e., if a farmer was investing in, a new building, some new raceways for cattle, etc., a set of yards, that would be arguably a capital investment. You'd think it'd go on term loan. However, some banks are sort of operating in such a lens that they're saying to farmers, just whack it on your OD. Well, that to many farmers is egregious. We all know that overdraft facilities have a higher interest rate. So
yes,
those kind of behaviourism we need to iron out. The rural industry, incidentally, when you're looking at the overall state of the books in terms of where money is going and who's borrowing it, the housing market has absolutely ballooned. The farming industry as a whole, the primary sector,